Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3, and this is Section A. This is an application topic. Calculate a required adjustment to the financial statements due to an accounting change, and that would be a change in accounting principle, or change in accounting estimate, or error correction, and determine whether it requires prospective or retrospective application. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training where we go over the key ingredients to passing the CPA exam. Again, it's only 1 hour, it is free, and we will show you how to be effective and efficient with your studying so you don't waste months or even years of your time. Also, after you watch that webinar, you're going to want to learn more, so make sure you check out becoming a pro member. Pro members get access to a lot of great stuff, mainly the pro course where Nate goes over in detail everything that you're going to be doing every day to be effective and efficient with your studying. So the pro course is a big deal, but you also get access to the full 10-question versions of these 5-question YouTube videos. So again, pro members get access to the full versions of these videos so that they can get extra practice and extra understanding. So remember to check out the webinar and check out becoming a pro member. And with all that, let's dive straight into the questions. All right, here we are at question 1. And something we always like to point out is you should read the last part of the question first. When you're doing questions like this, it might feel a little bit strange, but it is a very good habit to be in for test day, because on test day, you have no idea what you're going to be seeing. You could see 50, 100 different topics, and the quickest way to know what you're even looking for is to read the last part of the question, because that's usually what the real question is. And we'll see that right here. Using the straight line depreciation method, what is the depreciation expense for year 6? Okay, so immediately we know we're dealing with depreciation. Whereas if we hadn't read that, we might not know that we're dealing with depreciation expense until the very end of the question. Now, that might not be true in all cases, but again, this is a good habit to be in for test day because you'll be able to figure out what the question is asking for much more quickly. Now let's dive into this. So again, using the straight line method, what is the depreciation expense for year 6? Let's go up to the top. A company purchased equipment for $150,000 on January 1st, year 1, with an estimated useful life of 10 years and a salvage value of $10,000. After 5 years, the company determines that the equipment's useful life should be 12 years instead of 10 years, and the salvage value should be revised to $5,000. So with all that information, again, we have to figure out what the depreciation expense is in year 6 once they've made this change. Now, if you have any idea how to do this, if you've done similar things to this, then that's great. Pause the video and try to do this on your own. If you have no idea what is even happening here or how to calculate this, that's okay. We are using these questions to learn how to do the material. So we're going to use the answer to learn what we're supposed to be doing. So if you haven't paused the video already, let's go ahead and look at the answer together. All right, here we are. The answer is B, $10,714 is how much the depreciation expense is going to be in year 6. So let's walk through this, and we're going to learn what this even is as far as like what kind of accounting change this is, but we're going to learn how to deal with it first. So let's dive into the explanation. So to calculate the depreciation expense for year 6, we have to take into account the revised useful life and the salvage value. But first, we have to calculate how much they were depreciating each year before, so we know what the accumulated depreciation is and what the carrying amount is. So first we have to figure out what the depreciation was before, and that's pretty easy. We take the original cost less the salvage value, that's $150,000 less $10,000, and we divide it by the original useful life of 10 years, and that's $14,000 per year of depreciation. Now 5 years have passed, so we multiply 14,000 by 5, and that gives us $70,000 of accumulated depreciation that has occurred so far. Now we go back to the original cost, subtract the accumulated depreciation, and we know that the carrying amount as of the beginning of year 6 is $80,000. Now that we know that, we can then start determining what the new depreciation expense is going to be in year 6 based off of the new useful life and the new salvage value. So let's go ahead and scroll down a little bit. Okay, now we can see the rest. So again, we are taking the current carrying amount and subtracting the new revised salvage value and dividing it by the remaining useful life, and that's going to be the carrying amount of $80,000. The new salvage value is $5,000, and you might be a little bit confused about why is this 7 years. Remember, the original useful life was 10, but 5 years have passed, so before we changed anything, there was still supposed to be 5 years left. But they revised the useful life to 12 years, meaning there's an additional 2 years, so now there's 7 years instead of 5 years left. So again, $80,000 less $5,000 of the new salvage value, that's $75,000 divided by 7, which is the new useful life, and that's $10,714 of depreciation expense from year 6 onwards. Now, what does all this mean? let's start learning a little bit about that. This scenario is an example of a change in accounting estimate, as the company has revised the useful life and salvage value of the equipment based on new information. And again, remember, depreciation is an estimate. They're guessing or, making an educated estimate on how long something is going to last and how much depreciation is going to go into it each year. Changes in accounting estimates, such as here, an adjustment to useful life, an adjustment to salvage value, or an adjustment to maybe something else like bad debt, reflect updates to assumptions about future economic benefits or asset values. So how is this treated? How is a change in accounting estimate treated? Under US GAAP, changes in accounting estimates are accounted for prospectively, meaning they only affect the current and future periods, not prior periods. This is because estimates are inherently uncertain and can change as new information becomes available. Thus, only the remaining carrying amount is depreciated over the revised useful life starting in the year of the change. So just to summarize that one more time, a change in accounting estimate, something like depreciation or maybe bad debt expense, that is accounted for prospectively, which means that you just make the change in the current year, and then that change takes effect in that year and future years, but you don't go back to previous years and make any changes, which would be something called retrospective change. And we're going to talk about that in a little bit. Again, change in accounting estimate, you do it prospectively, meaning it's for future years, not for prior years. With that, let's go to the next question. All right, here we are at question 2. What amount should the company recognize as warranty expense for year 4? On January 1st, year 1, a company estimated that its warranty expense would be 2.5% of sales based on historical data. By the end of year 3, after a review of recent warranty claims, the company determines that its warranty expense should be instead 3.2% of sales going forward. Sales for year 4 are projected to be $2,480,000. Again, what amount should the company recognize as warranty expense for year 4? Now, this one is a little bit easier, I would say, than the previous one. But again, we are still trying to learn a little bit about accounting estimates. Based on what we learned in the previous question, you can probably figure this out. So go ahead and pause the video and come back when you're ready and we will look at it together. All right, here we are. The answer is B, $79,360 is going to be the warranty expense starting in year 4. And again, this is a change in accounting estimate because originally they estimated a warranty expense of 2.5%, but then with new information, they're estimating 3.2%. And also, the sales for year 4, they're just projecting it. Again, that's another estimate. So that's just another indication this is a change in accounting estimate. Okay, so I explained that first part of the explanation already. Accounting estimates, again, are adjusted prospectively, meaning that the new estimate is applied only to current and future periods without affecting prior periods. So to calculate it, it's pretty easy. We take the revised warranty rate and the projected sales, and that gives us $79,360. Again, this one was a lot easier than the first one, but it's just another reminder that if there's a change in accounting estimate, it is accounted for prospectively, not retrospectively. Now we're going to go talk about accounting principles and error corrections, and we're going to change gears with those. So let's go ahead and go to question 3. All right, here we are at question 3. What amount should be reported as the cumulative effect of this change in accounting principle to retained earnings at the beginning of year 4? Okay, let's go to the top. A company has been using the LIFO, last in, first out, method to account for its inventory. On January 1st, year 4, the company decides to switch to the FIFO, first in, first out method. As of December 31st, year 3, the company's inventory under LIFO was valued at $320,000, while it would have been valued at $400,000 under FIFO. So again, what is the cumulative effect of this change in accounting principle to the retained earnings? Now, this is something new. This is a change in accounting principle. We haven't been talking about that. We talked about changes in accounting estimates previously. So how does this work? What happens here? If you don't really know how changes in accounting principles are treated, that's okay. We're going to dive into the answer to learn how this works. All right, here we are. The answer is D. There would be an $80,000 increase to retained earnings. So let's walk through this to understand what's going on. Changes in accounting principles, such as moving from LIFO to FIFO, are usually applied retrospectively. So again, this is different than prospectively. This means prior period financial statements are adjusted to reflect the new principle as if it had always been in place. This retrospective adjustment often involves recalculating prior inventory values and adjusting retained earnings for the cumulative difference between the old and new methods. For this question, the company is changing from the LIFO method to the FIFO method for inventory valuation. So how do we calculate that? It's actually pretty easy. You take the difference that there is in the current year. So the inventory is currently valued at $320,000 with LIFO, and it would be valued at $400,000 with FIFO. So the difference is $80,000. the cumulative effect of that change in accounting principle is just that $80,000 difference. So there's an increase to retained earnings of $80,000. So that's kind of the idea with changes in accounting principle. You figure out what the cumulative difference is, and that is the change you make to the retained earnings. And it seems like frequently with changes in accounting principle, you basically need to know how they work, that they are applied retrospectively, and that you are correcting or changing things in prior periods to then get the cumulative effect that you are going to apply to the retained earnings in the current year. Now there's a few additional things I want to talk about here. First, it is frequently impracticable, or basically you really can't do this, to apply a change to LIFO retrospectively. So what does that mean? If, for instance, we were going from FIFO to LIFO instead of LIFO to FIFO, it's hard to do this retrospectively. Now let's talk about why. This is because LIFO requires maintaining detailed layers of inventory costs based on the specific units purchased in each period. These layers can be challenging to recreate accurately, especially if inventory records are incomplete or if prices fluctuated significantly over time. As a result, switching to LIFO often does not allow for a cumulative adjustment, and instead, the new method is applied prospectively going forward. So, dollar value LIFO, or maybe just LIFO in general, it's hard to apply a change to retrospectively go back and change all of your inventory costs to LIFO, because a lot of times people don't keep track of that the way that they're supposed to for LIFO. So frequently, if you change from one method to LIFO, a lot of times you actually might apply LIFO prospectively, you just use it going forward, but you don't go back. So that could be something that you see. And also one more note, if it is not possible to tell if something is a change in accounting principle or a change in estimate. So if you can't really tell if something is a principle or an estimate, it is treated as a change in estimate. Now, that's about as far as it seems to go for the CPA exam. I haven't really seen any examples of when it is difficult to tell if something's a principle or an estimate. Basically, what you need to know is that if you can't tell, or it's impossible to decide if something is a change in accounting principle or a change in estimate, you treat it as a change in estimate, which means that you apply it prospectively, not retrospectively. So that's the general idea behind a change in accounting principle. They are applied retrospectively, which means you find out the cumulative change by applying that change to previous periods, and then you apply that cumulative change to the retained earnings in the current year. But sometimes LIFO might be applied prospectively instead of retrospectively if you're changing from something to LIFO, or if you can't tell if something's a change in accounting principle or a change in estimate, you apply it as a change in estimate. Now let's go to the next question. All right, here we are at question 4. Ignoring taxes, what is the correct journal entry to adjust for this error at the beginning of year 4? On January 1st, year 1, a company purchased equipment for $45,000. Instead of capitalizing and depreciating the equipment, the entire amount was expensed as repairs and maintenance expense in year 1. The equipment has an estimated useful life of 5 years and no salvage value. The company uses the straight line depreciation method. It is now the beginning of year 4, and the error is finally discovered at the beginning of year 4. So again, ignoring taxes, what is the correct journal entry to adjust for this error at the beginning of year 4? So this error occurred 3 years ago at the beginning of year 1. How are they going to change this now that we're in the current year? How are we going to change this in year 4? If you have any idea how to do this, that's great. Pause the video and try to figure this out yourself. If you have no idea how to do it, that's okay. We're going to learn how to fix this error. All right, here we are. The answer is A, you would debit equipment for $45,000. You would credit retained earnings for $18,000, and you would credit accumulated depreciation for $27,000. So let's go through this to understand what's happening here. This is finally the third thing that we're talking about, which is error corrections. So we've talked about changes in accounting estimate and a little bit about changes in accounting principle. Now we're talking about how error corrections are treated when it comes to prospective, retrospective, and things like that. So let's scroll down a little bit just to see the full explanation. Okay, here we go. Since the equipment was mistakenly expensed in full in year 1, the company overstated its expenses by $45,000 and understated retained earnings. To correct this error, the equipment should be recognized as an asset, and the appropriate accumulated depreciation should be recorded retrospectively. So again, we are correcting this error, but we're correcting it in the current year because we don't have access to the previous years. So we are assuming the corrections were made in the previous years now that we've discovered this error, and this is going to be the cumulative effect that it has in year 4. So first off, let's talk about the equipment itself. The equipment should have been recorded on the balance sheet as an asset. So we haven't had a $45,000 asset on our balance sheet for the past 3 years, so we need to add that. So we debit equipment $45,000. Then we figure out the depreciation that should have been occurring for the past 3 years. So we take $45,000 divided by the 5-year useful life, that's $9,000 per year. Multiply that by the 3 years that this error was happening, and that's $27,000 of accumulated depreciation that should have been occurring. So we are going to credit accumulated depreciation because that's what should have been happening over the past 3 years. Now, what happens to the retained earnings? The retained earnings is going to make up for the difference in the expense that was still not taken care of. And again, we're not talking about taxes at this point. The full $45,000 was expensed in year 1, meaning that the expenses were overstated by that full $45,000. We need to adjust retained earnings by reversing this expense and recognizing the accumulated depreciation for the 3 years, which is $27,000. So we've made up for $27,000 of the overstated expense by doing accumulated depreciation, but we still need to make up for the $18,000 left of expense that was incorrectly overstated. So we credit retained earnings for that amount as well. So we debit equipment for $45,000, we credit retained earnings for $18,000, and we credit accumulated depreciation for $27,000. So with all that, we've been talking about an error correction this whole time. Error corrections are treated retrospectively under US GAAP. This means, same as before, that prior period financial statements are restated as if the error had never occurred. This involves correcting and restating the prior period financials to correct the cumulative effect of the errors. Now, what does that do? This is then shown in the beginning balance of retained earnings in the period presented. So again, you are going back, restating, correcting the prior period statements, but if we don't have access to those, like if we're not looking at those, the cumulative effect in the current year is that you just adjust retained earnings for the effect of those error corrections that you made in previous years. So again, it's similar to a change in accounting principle in the sense that you apply it retrospectively. You fix things in the previous years, and then you take that cumulative effect of those changes and you apply it in the current year in the retained earnings and anything else that you may need to do, like, debiting equipment or crediting the accumulated depreciation. So with all that, we've talked a little bit about error corrections. Now let's go to the next question. All right, here we are at question 5. During year 3, a company discovered the following errors in its financial statements. In year 1, inventory was overstated by $30,000. In year 3, depreciation expense was understated by $12,000 due to an error in calculating the depreciation on one of its buildings. Oh, and I forgot to read the last part, but sometimes you forget to do that. What is the net effect of these errors on the beginning retained earnings for year 3? And we also know that the company's tax rate is 25%. So the net effect of these errors, what is this going to do to the retained earnings of year 3? Now, we just talked about error corrections, so think about these errors that are discovered and think about how they would affect year 3 if they were corrected in the previous years. How would that roll into the retained earnings of year 3? Pause the video if you want and try this on your own, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is A. A decrease of $31,500 to retained earnings is what's going to happen. So let's walk through this. So to determine the net effect of these errors on the beginning retained earnings for year 3, we have to calculate the after-tax impact of each error. So you may sometimes, depending on what the question says, have to take into account the taxes as well as the error to figure out the actual net effect. So let's walk through this and let's scroll down just a little bit to see everything. So first, the impact of year 1, that was the inventory overstatement. An inventory overstatement in year 1 would have caused an understatement of cost of goods sold and an overstatement of net income by $30,000. And the way you can think about this is if you think of the COGS equation, COGS equals beginning inventory plus purchases less ending inventory. So if the ending inventory is higher than it should be, then you are subtracting more ending inventory from the beginning and purchases than you should have, meaning COGS is going to be lower than it should be. So if inventory is overstated at the end of the year, that means that cost of goods sold is understated. And if cost of goods sold is understated, that means that there was less expense, meaning that net income is overstated by $30,000. So what does that mean? We go down here to the after-tax impact. We take the $30,000, multiply it by 1 less the tax rate, so by 0.75, and remember the tax rate is 25%. That's $22,500. This is the amount of retained earnings or the amount of income that was overstated. So you're going to decrease retained earnings by $22,500. And again, that is net of tax. Now let's go to the impact of the year 2 error. An understatement of depreciation expense in year 2 means that expenses were understated, leading to an overstatement of net income again. So another overstatement of net income. So $12,000 multiplied by 1 less the tax rate, that's 0.75, gives us $9,000. So again, we decrease retained earnings by $9,000 because it was $9,000 too high net of tax based on the net income from this error. And then we go down here, we calculate the net effect on retained earnings. and that's these two together, $22,500 plus $9,000, $31,500. So we are going to decrease retained earnings by $31,500. So if you ever have to do a question that's net of tax, you just take one less the tax rate and multiply it by the error, but you'll have to pay attention to whether that error is an increase or a decrease to retained earnings. If it's a decrease to retained earnings, that would be because net income was higher than it should have been based on something, so you're bringing net income back down. Or the other way around, if net income was lower than it should have been, you are bringing retained earnings back up. Again, still net of tax because it should have been higher. Because remember, retained earnings is net income rolled into each other each year. Now let's go down here to one last note that I want to make, and because you might see this on the exam, but I didn't really cover it in these questions. If you are dealing with comparative financial statements, as in you see multiple years of net income and retained earnings and expenses and things like that. So like, year 2 and year 3 or year 3 and year 4 or whatever the case may be. For any years not shown, so in this case, the years that are not shown would have been year 1 and year 2. We weren't given the information for, net income and retained earnings and whatnot for year 1 and year 2. We were just told about the errors. If you're just told about errors but not given like the comparative financial statements for previous years, you just adjust retained earnings with prior period adjustments. So basically you're assuming that the errors were corrected in those prior year financials, but since you don't have access or you're not looking at those prior year financials, you're just taking that cumulative effect and applying it as a prior period adjustment to the current year you are looking at. However, if there are multiple years of income and retained earnings presented, so if you do see year 1 and year 2 in the previous years, any errors are corrected in the actual accounts that need correcting in those years, not as prior period adjustments. So let me try to reiterate that one more time. If you do have access to the year 1, year 2, year 3 comparative financials, like you can see the comparison between all the financials of those years, if you're correcting errors, you're actually just correcting the error in the year. So you would correct the error in year 1 because that would roll into year 2. You would correct year 2's errors and that would roll into year 3, and that would show you the cumulative effect in year 3, and then you would have the correct amounts for year 3. But if you don't have access to year 1 or year 2, you are just taking the error corrections and not applying them actually like in those years. Hopefully that will actually be done at some point, but you're just applying it as a prior period adjustment to the current year. I hope that makes sense, but basically we didn't really go over that in this, but I wanted to kind of tell you about that just in case you see something like that. If you see comparative financial statements, correct the errors in the actual years. You're not just doing prior period adjustments. But if you don't have the previous years, you do a prior period adjustment for the current year you're looking at. And with all that, we've gone over a lot in just 5 questions. Let's do one more part of the process called pillar topics. Now, the idea behind pillar topics with SuperfastCPA is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 3 or 4 questions trying to teach you how to calculate a change in accounting estimate and the effect that it has on the current period. Or you see multiple questions trying to teach you how a change in accounting principle is treated, which would be retrospectively, right? So again, you see these things keep popping up throughout the questions. You're not focusing as much on the things that you only see one time. You're focusing on the themes that keep popping up in the questions you're going over. And then you take some time to write these pillar topics out in your own words, kind of as a summary of the most important things you learned. And as you do this each day, you are going to be building your own personal repository in your own words of the most important things you need to know for the exam. Now let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive into it. Again, this is kind of a summary of what we just went over. Changes in accounting estimates. For changes in accounting estimates, such as useful life adjustments or bad debt provisions or warranty expense or whatever the case is, these are accounted for prospectively, affecting only the current and future periods. So remember, you don't go back and correct it in previous years or change it in previous years. You just do it moving forward. Changes in accounting principles. Changes in accounting principles, such as moving from FIFO to weighted average, are generally applied retrospectively, requiring prior period financial statements to be restated for consistency unless it's impractical. And again, when is it impractical? If you switch to LIFO, a lot of times that can be impractical. Switching to the LIFO inventory method is often difficult to apply retrospectively due to challenges in restructuring historical LIFO layers. In such cases, the change may be applied prospectively. And there it might be talking about dollar value LIFO. Just know that there are occasions where you might apply a change in accounting principle prospectively. And as far as applying something prospectively when it comes to a change in accounting principle, when it is impossible to distinguish if an adjustment is a change in an estimate or a change in principle, it is treated as a change in estimate affecting future periods only. So if you can't tell if something is a change in estimate or a change in principal, you treat it as a change in estimate, which means it's going to be applied prospectively. And then finally, for error corrections, errors in prior financial statements like overstated revenue or unrecorded expenses are corrected retrospectively by adjusting retained earnings and restating prior period financials. Basically, you restate the prior period financials, and whatever the cumulative effect of fixing that error is, you're going to be adjusting retained earnings in the current year for that change or that error correction. And with that, we've gone over the pillar topics for this video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, sign up for that because it's only 1 hour, it's free, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time. And I'm sure you're going to want to learn more after you watch that webinar, so make sure you check out becoming a SuperfastCPA Pro member, because Pro members get access to the Pro course where we explain the whole strategy very in depth, and also they get access to the full 10-question versions of these 5-question YouTube videos where I go over 5 more questions so that Pro members can get a little bit more help and a little bit more understanding with these topics. Now, if you liked the video, make sure to like it and leave a comment. Thank you for watching, and I will see you in the next video.